Peter, are you in the room? Hello, Peter, are you in the room? Shukra.
Yes, good morning, sir. I'm trying to check. He's not here yet. Let me check with him. He'll be joining shortly, sir.
Okay, but do you have how many people? How many students are we expecting? How many do we have?
We have about 60 interns and then about 30 other people also registered to join them to this session.
How many people are we expecting?
About 90 altogether.
What class? I mean, you have 20, like 20 people in the room already. How many? How many classes? Is it the first, second, or third class?
This is the third class.
Third class. What's the average attendance?
I think about 30.
Okay, I think we can proceed then. Maybe others will join us later. Peter, how are you?
Yes, good afternoon, everyone.
Okay.
Good afternoon.
So do you want to do as the
Suraj Oyewale.
faculty, as the team, as the training lead? You and Shukra,
Yes,
do you want to do
I
some
would start now.
Okay.
I welcome everyone to the third session of the Fortrose Virtual Internship, and I thank everyone for sticking with us since the first session. So, good afternoon, everyone, once again. Like, as it is our protocol here, I would advise everyone to mute their microphone so that we can just begin in time. So I'm sure everyone can see my screen. You can see the training guide and everything. So by the time I'm done with the introduction, and the new screen will be shared by Mr. Suraj Oyewale. So with us there is Mr. Suraj Oyewale. Suraj Oyewale is a tax professional and award-winning accountant with over a decade experience in the Nigerian oil and gas industry. He holds a first-class degree in economics from the Obafemi Awolowo University. And as a public policy analyst, he regularly gets invited by TV stations, university student associations for his expert views on oil and gas, taxation, fiscal policy, economic policies, and career advice. So as mentioned earlier, he spent his career largely in the Nigeria's oil and gas sector. So with experience in the downstream, midstream, and upstream operations. After 14 years in the energy industry, he then started a career in consulting, where he now serves as CEO of Fortrose Consulting. In the last 2 weeks, I have been taking awesome participants in the internship on introduction to the energy sector by presenting it in a simple yet comprehensive fashion. So earlier this week, we had a deep dive into the regulatory and licensing regime, and with an impressive performance or participation by the participants also. So today we'll be discussing fiscals as money makes the world go round. So an understanding of finance from the perspective of the government and the industry operators is then crucial for your knowledge in the industry. So that's why we've included this special session to be presented by an expert in that area itself. So in this session, Mr. Suraj Oyewale will be analyzing fiscals and accounting in the Nigerian petroleum industry. Welcome, Mr. Suraj. It is so good to have you here.
Yeah, thank you very much, Peter. How are you guys? Most of you might have come across my name somewhere before. Some of you might be following me on social media. So my name is Suraj Oyewale. I'm known as Jarus. I'm the CEO of Fortrose Consulting, the firm that is organizing this internship training for you guys. And my good team have done a good job of starting before I joined. They've organized 2 classes for you, and I want to believe that you guys are now getting more and more familiar with the energy sector of Nigeria. And one of the reasons we have put together this internship is to give some sort of advantage over other people, so that when you begin to search for a job, when you begin to go for interviews, you are already familiar with some of the things, some of the terms, some of the processes, some of the operations of the energy industry, so that gives you an advantage. In You can even put it in your CV, Photos Energy Consulting, Photos Consulting, Energy, Virtual Energy Internship or something. That shows you. Somebody may find it curious on your CV, and it might ignite some discussions, and that might be what the person will see and determine to give you the job. So I think you guys should take it very, very seriously, and I hope that ultimately at the end of this internship session, you guys are going to be better for it. You guys are going to get to know more about the energy industry of Nigeria. You guys should be able to hold basic discussion about the energy industry. You guys will be able to speak on energy topic. You guys will be able to understand when you are listening to news and they are talking about any topic within the energy industry. So that's the aim of having this internship with you guys. So today's topic is the petroleum fiscals of the oil and gas industry in particular. And when we say fiscals, we essentially talking about matters of revenue and expenditure, matters of government spend, how government raise money and how they spend it. Okay, so essentially, because when you have an oil and gas industry, I'm sure all of you here that Nigeria gets a lot of money from the oil and gas industry. Why do they get it? So that's essentially what you're going to be talking about. How do they get it? What are the things that the what are the things that the how do they get it? What are the things that the law, what are the avenues within the law within with which they get all these their own take? Because ultimately government is the owner of the country. Government is whatever you do in the country, you are you have to be under government. Like you need government license. So of course government makes money from the oil and gas industry. Number one, through grant of license, through grant of license. Okay, because don't forget the fact that everything under the soil of Nigeria, everything within the waters of Nigeria is owned by the government of Nigeria. Okay, but government cannot do it alone. So government now issues licenses to oil and gas companies. Sometimes they partner with them through their own vehicle, NNPC. And so they issue license. When they issue license to them, when they bid for license, they pay an amount of money uh, down. So when they also win the bid to own that whole feed, they also pay what is called a signature bonus, the money you pay to get into it. So, and government makes money from these things, from this signature bonus. Okay. But beyond that, government needs to, apart from that one-off payment that is made to government when people are leasing, it's actually called leasing, or because it is a time-bound ownership. It doesn't mean that the fact that you cannot permanently own a what's the name? You cannot permanently own a what's the name? You cannot permanently own an oil field. So you get license to be the one to operate it within a number of time, within a period of time. It could be 20 years, it could be 5 years, it could be 3 years, depending on whether it is, depending on the type of license. Okay. So now, in the process of operating, while you are making money from your own oil, while you are drilling, exploring, producing, selling the crude oil, you need to be able to you need to be able to government needs to be able to also get some things from you, some cut from the money you are making then. So the mechanism for government take, okay, from the oil and gas activities are called the fiscal terms. Okay, fiscal terms. As an investor coming to Nigeria, for example, you need to be familiar with the fiscal terms of Nigeria's oil and gas industry. Compare it. What are the taxes applicable? What are the rates of each of them? Is there any incentive? What are the things that are exempted? All those things you need to be familiar with them. You run your economics, you run your model, you compare with other countries. Angola, for example, what is the tax rate in Angola? What is the royalty rate in Angola? All these things, you compare them and you make decisions on whether you want to invest in Nigeria or whether you want to invest in Angola, for example, any other oil producing country. So fiscal terms are very, very important because they are what ultimately sometimes they are, apart from factors like politics, okay, matters like the fiscal terms also matter, also determine whether a um, whether I'm trying to share screen. Okay. Let me see this screen. I'm sharing the screen. So because those matters also determine whether people will what country, what of all the options available an to a business, where you will allocate the capital. For example, Shell has various operations in more than 50 countries of the world. Okay, so they can determine. You look at the fiscal terms of each country. What are the tax rates? What are the royalty rates? What are all of these things to determine what country they should invest in and what should be, what should we do this year? What should we defer and all of those things? Okay, so fiscal terms are very, very important, and that's what we'll be talking about today. Okay, so fiscal policy is just an economic policy that relates to tax and spending. Okay. If you are someone that is familiar with the news, you have heard that President Bola Tinubu recently set up a committee called the Fiscal Reforms Committee, led by Mr. Taiwo Idili, my former boss at PwC. Okay, to look at the tax issues in Nigeria and recommend to government where they can do better, where they can what they can do, how they can reform the tax system. So that is a fiscal matter. Okay, that's a fiscal matter, but it goes beyond fiscal matter. It goes beyond fiscal matter. Okay. Um, okay. So um, so so it goes beyond. So the only difference is that what Tayo Idele is doing for federal government is generally about all the matters, all the various industries, like the broad economy. But here we are talking about petroleum fiscals, rules relating to petroleum activities in Nigeria. Okay. I don't know whether Peter has told you before. Can anybody tell me the difference between upstream, midstream, and downstream in petroleum matters? I don't know whether Peter, you've told them, you've covered that in any of the previous classes. Have you? Can anybody in the room? Have you covered it to them, Peter?
Yes, we have covered it
Okay,
elaborately, sir.
tell me.
Yes, I
Okay.
can contribute.
Good afternoon, sir.
Good afternoon.
Hello.
Yeah, good afternoon.
Okay, I think
Good afternoon, sir.
upstream.
Can I go ahead?
Go ahead, Adam.
Okay. Yes, sir. Upstream deals with exploration and production. Midstream deals with hydrocarbon processing and transportation. Downstream deals with petroleum products, depot and operations.
Exactly. Marketing and distribution and importing. Exactly. That's correct. Okay. So
Thank you,
as we
sir.
go on, bear that in mind. Okay. Okay. Good. So can you see my screen now? Can you see my screen?
Yes, we can.
What are you seeing? What's the title of the screen you are seeing?
Section 3, Petroleum Fiscals.
Okay, good. Okay. So fiscal policy is just matters of government spending and taxes. Like how the government, the matters relating to taxes and related activities. That's uh, government fiscal policy. Okay. So the Petroleum Industry Act, which is the main law guiding oil and gas industry activities in Nigeria, okay, that was passed on August 16, 2021 by President Muhammadu Buhari, PIA, after almost 20 years of back and forth. As the main law guiding oil and gas activities in Nigeria, Chapter 4 specifically deals with fiscals. So that Petroleum Industry Act has 5 chapters. Okay? Chapter 4 specifically deals with matters of taxes, royalties, and all of that. That's fiscal matters. Okay? And the objective of that is to encourage investment in the industry and enhance revenues for government, because government, we also need some cuts from the activities in industry. Government is providing defense, providing a lot of things for people. So government also needs to make money from its resources. So apart from the fact that the government gets paid for the licenses, for the signature, for the all of those things and approvals, they also make money from the business side of things, from the way you are operating, from the and all of this. So matters around all of those are set. The rules are in chapter 4 of the PIA. Okay. Before the PIA, the rules on matters of taxes within the oil and gas industry for oil and gas operations are within a law called the Petroleum Profit Tax Act. Okay. So the PIA introduces some new taxes. Number 1, hydrocarbon tax. That's an entirely new tax. We'll talk about it. PI introduces that hydrocarbon tax. Now, number 2, company income tax has always been existing. Okay? There's a separate law for it called the Company Income Tax Act. Company income tax has always been existing. But PIA now says that company income tax will now apply to upstream operations. Before, company income tax was applying to only all businesses in Nigeria except upstream operations. So downstream operations have always been covered by the PIA. Midstream operations have always been covered by the PIA. So all marketing companies that own filling stations, like Wando, like all of those guys, they have always been subject to company income tax on their profit from the downstream or midstream operations. The same company income tax that applies to every other company in Nigeria, including whether it's a supermarket whether it's any company that is registered as a limited liability company or PSU. This company income tax has always applied on it, except upstream activities. That's production, which has its own law called the Petroleum Profit Tax Act. So PIA now says, you know what? No. Petroleum profit tax is going to go. Company income tax is now going to apply to even upstream activities. Another tax is tertiary education tax. This one has always been existing. Okay, so it's not a new introduction. Withholding tax on dividends has also been always existing. even though at some point the profits from petroleum activities, dividends from petroleum exploration activities were exempted from withholding tax. But this has now been removed and it's now applied. So example of taxes that apply in the oil and gas industry include hydrocarbon tax, companies income tax, tertiary education tax, and withholding tax. And of all of these, only hydrocarbon is really only hydrocarbon tax is specifically for oil and gas operations. Others apply beyond oil and gas. Okay. So, for example, if you own for us as a Fortrose Consulting, for example, we are not an oil and gas company, we are just a consulting company. We are subject to company income tax, we are subject to tertiary education tax, and there's withholding tax on our dividends to our shareholders. Okay, so all companies in Nigeria that treated as a limited liability company are subject to all of those ones. Okay, hydrocarbon tax is just the only tax that is peculiar to upstream oil and gas activities. So we'll talk about each of those ones as we go. Hydrocarbon tax. Are you seeing my screen? Is it showing hydrocarbon tax?
Yes, sir.
Is it showing
Yes,
hydrocarbon tax? Okay, good. Just to be sure it is. So let's take each of those taxes. So hydrocarbon tax applies on profits of companies engaged in upstream operations. Like I said, upstream operations deal with exploration and production, like the process of going into the ground or under the water to bring the crude oil or crude gas, to bring the crude activities from their place of formation, from the reservoirs. That is upstream activities. Process of exploring and producing crude oil. So hydrocarbon tax applies on them according to the Petroleum Industry Act, Chapter 4, fiscal terms. But there's an exemption. The only exemption is deep offshore operations. Deep offshore operations. So even though they are upstream, deep offshore operations are exempted from hydrocarbon tax. So what are deep water operations? Deep offshore operations. Deep offshore operations are petroleum activities in water, in the ocean, in water depth that's more than 200 meters. So any production activity that you are doing in water that is deeper than 200 meters, that is deep offshore operations. Okay? You have shallow water. Shallow water is if it is inside the water, but the water is not so deep, it's just less than 200 meters. That's called shallow water. But if the activities is within, if you are producing oil in a sea that is deeper than 200 meters, that is called a deep offshore operation. That is exempted from hydrocarbon tax, and that's reasonable because to be going to explore and produce oil inside deep water, I mean, you need to spend a lot of money. So the government needs to incentivize you. The government needs to encourage you. Like, say, okay, no worry. I will not. You not pay this tax. You not pay this hydrocarbon tax because I know that it takes a lot of investment to go and concentrate, to go and drill a well in water depth of more than 200 meters. Sometimes as deep as 200, as 1,000 meters. You see oil companies that take helicopter from Port Harcourt, from Warri, deep into the water. That platform on top of water, where they drill inside the water and they bring out the crude oil. Government exempt those activities from hydrocarbon tax. But all other upstream activities within shallow water, swampy areas or on onshore activities around on the ground, like all these Niger Delta areas that are not, all those ones are subject to hydrocarbon tax because those ones are they are easier they cost lower investment. Okay, and so those ones are not exempted from hydrocarbon tax. Okay, so all upstream operations except deep offshore operations in relation to crude oil, condensate, and liquid natural gas derived from associated gas and produced in the field option of measurement. Forget about all those words. What I've said, crude oil and condensate within whether in offshore, whether in onshore means production on the ground, or shallow water that is lower than 200, that is not as deep as 200 square meter, 200 meter rather. That is, those ones are subject to hydrocarbon tax, and that's because the government needs to encourage investment in deep water, so those ones are exempted. Remember, there has been news in recent times that Shell is selling their onshore assets, okay, and they're now going to concentrate on their assets, on their feeds, on their production activities in deep offshore. This type of thing they're talking about. Deep offshore means they don't want to be inside water. That's where they want to, because that one is even exempted from this tax. So all the activities within the area of Niger Delta, Warri, Port Harcourt, all those ones on the land, we are selling them. But the activities we have inside water, that is the one that is now subject to, that is one they want to focus on. Okay, remember that news. So that is this. Okay, but hydrocarbon tax does not apply on gas. Doesn't apply on gas production, whether it is onshore or whether it is offshore, irrespective of where it is being gotten. It doesn't apply on gas, and that is because government realizes that gas is not as expensive, gas is not as valuable as crude oil. So don't let us stress them too much. Let's exempt it from hydrocarbon tax, one. Secondly, gas is also, government is also trying to encourage investment in gas. So that's why they have exempted gas from this hydrocarbon tax. But the law says liquid natural gas derived from associated gas. So this one is just saying that, but it's a form of gas that is still in liquid form, like before they separate them. Okay, that one that is still like crude oil, that one is subject to hydrocarbon tax. Condensate is also something that comes from crude oil, like when you go to the ground to drill, when you drill the ground and you produce these things, some of those things are mixed. Water is mixed there, crude oil is mixed there, condensate is mixed there, all of those things are mixed. So there are processes of separating them. When they are separating them, the crude oil most valuable, condensate, they also sell those ones. Okay, so condensate, crude oil, those ones, hydrocarbon tax are applying them, and even liquid natural gas. Okay, but the normal natural gas, that one is exempted from hydrocarbon tax, as well as oil operations in deep offshore. So hydrocarbon tax rate is 30% for onshore and shallow offshore. Okay, is 30%. So like I told you, hydrocarbon tax applies only on onshore or shallow offshore acreage. Can somebody tell me what is the depth of what is the shallow water, shallow offshore feed?
Good afternoon, sir.
Good
From
afternoon.
your explanation, I would say that a shallow offshore field is an oil field that is not up to 200 meters.
Deep, correct. Just wanted to be sure your focus are following. That's correct. So those kind of feed, crude oil that is being produced from those kinds of feed, as well as the one that is produced on land, called onshore, is both are subject to hydrocarbon tax for converted or renewed feed. Now, let me now tell you something. Converted or renewed feed, let me tell you what they mean. Converted or renewed feed is just, I told you that in 2021, there was a new law called Petroleum Industry Act, okay? That act now says that all the fees that has been apportioned to be allocated to different oil and gas companies before that law, okay, you have a right to keep them, okay, okay, until the expiration of the term under the license you collected. When you want to renew, automatically it becomes you renew under the PIA. That the license that was given to you before 2021, when you had been allotted that license, that one is not because it's unconverted. If you have two options as an oil and gas company, you may decide to convert that license. When you convert it, the rules of the Petroleum Industry Act will apply. Or you may decide not to convert it and continue. If you have spent like 10 years out of the 20 years that is applicable, you leave it and it continues to operate under the old law, Petroleum Profit Tax Act and the Petroleum Act, until the license expires. When the license expires and you want to change it, you want to renew it, in that case, you can now, the new rules of PI will now apply. So, but you have an option to voluntarily go and convert and go and change it and go to DPR, the government regulator, and say, change it for me. Change my license to the new license under the PIA. And the licenses are also different. The names are also different. Under the whole law, the license that allows you to produce oil was called oil mining lease, OML. Under the PI, it is called petroleum mining lease, PML. So if you voluntarily walk up to the regulator of government and say, please, my field, I want to renew my license, I want to convert my license, the name changes from, let's say, OML 13 to PML 13, and the new laws under the PIA will now be the laws that will guide them. So for such feeds, onshore and shallow water feeds, that somebody voluntarily converts, 30% hydrocarbon tax will apply. Or if you don't convert, when you finish and you are renewing, automatic conversion. But for marginal feeds are small feeds, like small oil fields that are owned by, marginal means small, right? Sometimes this is marginal increase. Marginal means something small, right? Just imagine, just a small something. Okay. So for those feeds, okay, 50% we apply. And the same thing for petroleum prospecting leases, PPL, leases given under the new Petroleum Industry Act. That's another thing to know under the hydrocarbon tax. Either 30% or 15%. 30% if converted or renewed. 50% if you don't convert until it ends. But marginal feeds and PPLs, 50% also apply to that one. If you're a marginal feed is just a feed that is mostly all those indigenous companies that government wants to encourage to also participate. So the small feeds that have been abandoned for more than 10 years by the international companies, they give it to them for some payments. So another thing to know about the hydrocarbon tax, there is what is called, cost price ratio limits of 45% of gross revenue. Okay. Now, if any of you is familiar with small mathematics, okay, profit. Can you see what I'm writing? Can you see what I'm writing?
Yes, I can.
You can see, right?
Yes, I can.
So profit is equals to revenue minus cost, right?
Yes.
Right?
Yes. Yes, sir.
Yes.
For those of you that are also
Yes, sir.
business people, you know that profit is equal to revenue minus cost, right?
Yes.
Like profit is equal
Yes,
to
sir.
the amount you make from this your price times the quantity you sold minus the cost. Okay, that's the profit, right? On unit basis, let's say for 1 unit, profit on 1 unit, is equals to price, right? Right? Price of 1 unit minus cost of 1 unit, right? Right?
Yes.
I mean, if I buy a laptop for 70,000 naira and I sell it for 90,000 naira, what is the cost? If I buy a laptop for 70,000 naira and I sell it for 90,000 naira, what is the cost?
70.
The cost is 70,000
What is
naira.
the price? What is the price?
90,000 naira.
What is the price? What is the price?
90,000.
Alright, and what is the profit?
20,000 naira.
20,000.
Exactly. So, cost price ratio law is not saying that, and you know that tax is equals to tax rate times profit, right? Right? Like if tax is on profit, right? So if tax
Yes.
if I make a so exactly, so it's equals to, so tax on the, so let's say it is petroleum I'm selling, right? So let's say it's hydrocarbon tax. How much is the hydrocarbon tax rate? Let's say 30%, right? Let's say
30%.
30%, right? Times what's the profit from the example I laid above?
20,000.
naira.
10,000 naira. So what is my tax?
6,000.
6,000, right? So my tax is 60,000. So the government is now saying that, so this is it. Now, if you look at it, that in this example, what is cost price ratio here? What is cost price ratio in the example we did? What is cost? Cost is what? 70,000, right? Right?
Yes, sir.
Right? What is the price?
Yes, sir.
90,000.
6,000. How much is that in percentage? Okay,
0.78.
What?
77%.
0.78.
0.78.
77. Eh?
0.78.
No, I don't get it. Is it, what's the ratio? What's the percentage? It's maybe let's say percentage.
0.78.
77.8%.
Yes.
And let's just
So that means you need to multiply by 100.
So
It
this
will give you 7.
is 77.8%, right? Right?
Yes.
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 If you multiply by 100.
Government are not saying that. Yeah, exactly. That's why. Government are not saying that for all the crude oil you are selling, for me to calculate the hydrocarbon tax, all the crude oil you are selling, all the cost you have expended, okay, to make the revenue you make from that crude oil sales must not be more than what? 65%. So I will not allow you to deduct more than 65% for that year. If it's more than that, I will cap it at 65%, and the remaining you can add it to next year. So what is 65% of 70,000 of 90,000? So the price is what? 90,000 in this case, right? So let's say it's good that I'm selling. So the price is 90,000, right? So what is the 75, what is the 65% of 90,000?
58,500.
Exactly. So what that means is that profits. So my revenue, the revenue that will be allowed with me is, so my sales is still 90,000, right? Right? But the government is telling me that I cannot allow you to claim more than 65% of that, as your cost must not be more than 65% of that. So what's that 65%? You guys calculated it now.
58,500.
So what is the profit for tax purpose, for carbon tax purpose?
31,500.
31,500. So government is now saying, for me, in your own account, you can go and calculate 70,000 as your cost, deduct it from your 90,000, and say, okay, you made a profit of 20,000. But for me, according to the PIA, your cost must not be more than 65% of your revenue. So when the cost is capped at 65%, so the profit is how much? 31,500, right? So what's 30% of that? What's 30% of that?
9,450.
You can see that government will now collect a tax of 9,450 rather than 6,000. You get it? You get it? So by the calculation that is not capped, that does not follow that cost price ratio limit, government would have collected what? How much as tax? How much as hydrocarbon tax? 6,000 now.
6,000.
10,000 times 30%. When you calculated normally, 6,000, right? Abi?
Yes. Yes, 6,000.
But because of applying this law that says that the cost price ratio must not be 65%, the government did not allow you to deduct the whole 70,000 from your revenue. Rather, the government calculated it by deducted 65%, which is 58 something. So that shot up your profit by 31 million, to 31,000, right? And your tax is what? 9,450, right?
Yes, sir.
So government is now going to collect a higher tax, which is 9,450, because of this cost price ratio. But the good thing is that government will allow you to carry forward the difference. So you have how much was disallowed as your cost, how much of your cost was disallowed? Disallowed cost. How much was disallowed as your cost?
11,500.
How much?
11,500.
Exactly, 11,500, right?
11,000.
Yes, sir.
So 11,500, government will allow you to add it to your next year cost when they are computing this. Okay? So if next year your cost for next year is, let's say, 40,000, Abi, government will allow you to add this 11,500 to it. So 11,500 plus 40,000. So government will allow you to deduct 51,500 next year, provided it will still not be more than 65% of the revenue for that year.
65%.
If it is still more than 65% for that year, the government will still shave your head and still carry the balance forward for 5 years. So government is doing this because so as to disallow you from going to patch your cost, so that you will pay less tax That's the rationale behind this cost price ratio, which is capped at 65%. So if there was no law that says cost price ratio is 65%, this company would have paid a tax of 6,000 naira. But because of that law, this company is going to pay a tax of 9,450. Government, more money for government. But the 11,000 that they disallowed because it is higher than 5%, government will allow you to add it to the next year cost, provided that when they add it to next year cost, it will still not be more than 5% of the revenue for that year. For next year, if it's more than 5%, they will still chop it off and you add that one to the next year. You get it?
Yes, sir.
Do you guys get it? So
Not
that is the
really,
rationale
sir.
behind it.
Yes, sir.
Okay, who got it that can explain? Who got it? I want someone that got it to explain. Someone that understands it to explain. Can somebody
I
to explain?
understood it.
Okay, yeah, explain.
Can I go on?
Give us examples.
Okay, go
I can
ahead,
be,
sir.
let me say I can be writing it. Let me say,
Yeah, the idea is
let's create a new control. Oh, okay, let me
scenario.
create a new. Yeah, let me create a new scenario. For example, new scenario. Add slide. Let me add. Okay, let me even use. Let's use Excel. Let's use Excel. Let's use Excel. Let me now use. Let's use Excel. Cost price ratio, which is in the Petroleum Industry Act, capped at 65% of revenue. The cost must not be more than 65%. Let me go and let me share this Excel as my screen. Let me share this Excel. Okay, so let's say Jarus E&P Limited. Let's say that's the name of the upstream oil company, okay? Okay. So let's say in 2023, okay? Let's say crude price is let's say crude price is 50 crude price. Let me just be putting all these things there. Unit of measurements. Okay. So let's say crude price is measured in dollar, right? Per barrel. Dollar per barrel, right? So let's say crude price is $80, right? Right? Crude sold. So let's say crude sold is
Yes.
crude sold is okay. This barrel, that crude sold is in barrels, right? So let's say crude sold is 1 million, right? 1 million barrels, right? Are you following it?
Yes,
So
sir.
cost of all the operations, cost of everything, cost of all the operations in dollar. Let's say is 70. Okay, let me use 90 here. $90 is 70 million. Right? Are you following it? Do you get what I wrote here?
Yes.
Yes, sir.
So
Yes, sir.
let's say the crude price is $90 per barrel, right? Abi? And I sold 1
Yes.
million barrels, right? What's my revenue?
Yes.
What's my revenue from this?
90
As
90
90
million.
million naira. $90 million. Sorry.
Revenue is equal to price times quantity, right?
Mm.
Yeah.
Yes.
What is the cost? Cost is what?
70
70
million.
70 million.
70 million.
And what is my profit?
20
my
million.
$20 million.
80 million, right? So normally, what would be my hydrocarbon tax?
30%.
Hydrocarbon tax is what? 30%, right?
30%, yes.
So it's equals to what? It's equals to what? How much is that? 6 million, right? Right?
Yes, 6 million.
Yes. So government will take. So ordinarily, government will take. If there was not like cost price ratio, if no law on cost price ratio, government I will pay a tax of. I will pay a hydrocarbon tax of $6,000, right? To government,
Yes.
right?
6 million naira.
Yeah, to government, right? If there's nothing like what hydrocarbon, if there's nothing like hydrocarbon, sorry, cost price ratio, right?
Cost price ratio.
I will pay a tax of $6,000 to government, right?
Yes,
But there's not a law. There's a law in the PIA that says that
Yes.
for hydrocarbon tax purposes, your cost must not be more than 30%, sorry, 65% of your revenue. Your cost per unit must not be more than the what? 65% of your revenue. You got it?
65.
65% of your revenue. You got it?
Yes.
So what that means is that
Yes, sir.
under CPR, so with CPR cost price, with CPR, costs, 65% of cost is what? 65%. Costs must not be, costs should either be equals to, right?
Or less
Or
than.
less than what? 65% of price or revenue. If you are talking a bit on unit basis. You got it?
Yes, sir. Use greater than sign.
Oh, sorry, less than. Thank you. You got it? So under the Petroleum Industry Act, it says that for hydrocarbon purposes, your costs that will be allowed to deduct, okay, must not be more than 65% of your revenue. Price is the same as revenue if you are talking on per unit basis, right? If you are talking of the whole aggregate basis, you know, it's 65%. So what is 65% of what are we going to apply 65% against here?
90 million.
Correct.
$90 million, sir.
Which is 15,500, right?
Yes, sir.
So in essence, your allowable cost for 2023, that your deductible cost, that cost deductible cost, let me call deductible cost. Deductible cost for 2023 is how much?
$70 million, sir.
For under the CPR now, 58 million. So
58,800.
carried forward cost What is because they carry forward to another year? They are not going to allow for this year.
70
That
million
will be
minus
70 million minus 58.
58,500. 11,500.
Who doesn't understand it up to this stage to talk? So, under the law that says that cost price ratio must not be more than 5%, 5%, you are allowed to deduct not more than 5% of your revenue for tax purposes, for Hydrocarbon tax purposes. Is this now? So we now calculate the cost, revenue, and profit and Hydrocarbon tax under the. We now calculate it under the. We calculate it under the CPR, right?
CPR.
So revenue remains revenue, right? Revenue is not changing, right? 90%, right? But the cost that will be allowed is what? 58, right?
500.
Your profit increases to this, right? 31,
Yes.
Abi. So the tax that the government will take is going to be 30% of that 31. It comes to 9,450. With CPR, with cost price ratio, government takes a tax, hydrocarbon tax of 9,450. You can see that law was put in there so that government can make enough tax, so that you cannot go and pad your cost, so as to artificially reduce your profit and give government less tax. So government are saying that I'm not going to allow you to claim more than 5% of a cost that is more than 5% of your revenue, so that you don't go and pad your cost and tell me that your profit is 10,000 and go and apply tax on that and take small money. Meanwhile, you have done some abracadabra to increase your cost. So that is the essence of government coming up with this cost price ratio law. So you can see that under the cost price ratio, government is now taking a tax of 9,450. If there is no law as cost price ratio, government will take a tax of what? 6,000. Who still doesn't understand it? Now, let's now say in 2024. Okay? So let's say 2024. Abi? Let's say 2024.
Yes, sir.
Okay? Let's say the second year. Let's say the price of crude oil fell to, let's say the price of crude oil increased to 110, right? Right?
Yes, sir.
Let's say the crude oil government sold reduces to, let's say, 60. Let's say 600,000, right? So let's say in the next year, the price of crude oil increased to 110, right, per barrel. And the crude oil the government got, maybe due to Niger Delta vandalism and everything, the government could not, the company rather could not sell more than 600,000 barrels for that year, rather than the 1 million it sold in the following year, in the previous year. Okay? So let's say the cost of operation is now for that year is now, let's say it's now 35 million. Okay?
Yes,
Are
sir.
you
Yes,
there?
sir.
Let's say it's 35 million. So under the So I mean, under the, so the what's going to be the revenue for 2024?
66 million.
Good. The price per barrel times the number of barrels sold, right? Right?
Yes, sir.
Okay. The cost is how much?
35 million.
5 million, yeah.
So the normal profit is normal profit
31
Revenue
million.
minus cost.
1 million. And the tax, the government, ordinarily, if there was nothing like cost price ratio, what's going to be the tax? $9,300, right?
Yes,
Yes,
sir.
sir. Yes, sir.
Okay.
Yes, sir.
So with CPR, with cost price ratio, okay. So let's check whether what is 5% of our revenue. 42,900, right?
Sir.
Right?
Yes, sir.
So out of that 92,400, so that is less than the cost we can. That's less than. So that means there is a room for us to claim more. So I mean, so that means that you can see that 65% of the revenue for 2024 is 42,000, right? Right?
Yes, sir.
Okay.
So what that means is that we can claim up to 42,900 cost, right? Right?
Yes,
Yes,
sir.
sir.
Yes, sir.
Yes, sir.
Exactly. So what that means is that actual cost for 2023 is how much?
42,000
35.
nowadays, sir. Okay, 35, sir.
35. Cost
Gross
unclaimed,
profit.
undeducted costs brought forward from 2020. Sorry, actual cost for 2024. Sorry, 35,000, right? Undeducted costs brought forward from 2023 is how much? Is how much?
11,500.
11,500. So total cost available for deduction in 2024 is equal to what plus what? Is equal to what?
35 plus 11,500.
46,500.
4,500. But so we can, but we are not allowed to deduct more up to 4,500, right?
Yes.
So deductible, CPR deductible cost is equals to this, right? That 5% of the cost of the revenue, right?
Yes.
Right? So
Yes.
carry forward, let's
Right
say,
forward.
Yes, sir.
to 2025.
5.
So we have
46,500
40,000 minus this.
minus 42,900.
This and this one. So this is what you carry forward to next year. So our tax under the CPI for 2024 will be, what's the revenue for 2024?
66 million.
6 million. What's the cost that you can deduct for 2024?
42,900.
For the 2 years. What's the profit per this government calculation? 23,000, right?
Yep.
Right?
Yes, sir.
Yes.
sir.
So what's the profit? The tax government will take 6,390. You get it? That is tax government will take for this year. So can you guys get it now? You guys understand it?
Yes, sir. We're getting some.
Yes, sir.
Yes, sir.
Yes, sir.
So this is how that law on cost price ratio is essentially to avoid operators, oil and gas companies, from padding their costs, and for government to make sure that they have a decent revenue every year. Government decent tax every year, because people can go and pad their costs and say they make little profit, and the government will apply tax because tax applies on profit. Okay, so this is the practical implication of that cost price ratio, the law that is in the Petroleum Industry Act, which is essentially put in the law to make sure that the prices are not unnecessarily padded, so that government will not reduce that, so that we will not shortage government. Or even though they will allow you to carry forward the cost to next year, for this year, you cannot tell me that your cost is more than 5% of your revenue. If you tell me it is more than it, I will not allow it. I will only take it. So this is what cost price ratio is about in computation of hydrocarbon tax. Another fiscal thing, another way government makes money from oil and gas activity is what is called royalty. Okay, royalty. So because if government owns the land, government owns the resources on it. So if you are using it, even though you had already paid the signature bonus at the beginning of that license, you also cannot. You also have to pay royalty to government on production. Okay, so royalty applies on crude oil on all the various hydrocarbon resources. For crude oil and condensates, royalties apply according to the PIA, based on production and based on price. So as your production is different levels of production, like different levels of the oil you are producing, different levels of the royalty rate that we apply, different prices of crude oil in the market, different levels of royalty. And this is because government wants to be able to benefit from a period of windfall when prices go up. Okay, when prices of crude oil goes up, government wants to be able to also benefit some things from it. That's how government fixes royalty based on production and price. Okay, then for gas, it's just based on production. There's no royalty that's based on price. Even if the price can escalate, can go up to any amount, royalty will only be based on the amount of gas you are producing. That's what will determine your this. For the crude oil, for the royalty component of for the royalty that is based on price of crude oil, this is how it works. Okay, where the price, okay, is $50. Where the price of crude oil is $50, average for that month, okay, 5% you apply. I mean, if the crude oil per barrel, okay, is less than $50, okay, it's less than $50, okay, government will not charge any royalty based on price. You only charge royalty based on production. Okay, but if the crude oil price rises to $100, government are going to charge royalty at 5%. If the crude oil price touches $50, so $150 per barrel, government is going to charge you an additional price-based royalty at 10%. Okay, but where the royalty is based on is in between all these numbers. Okay, all these numbers, then what is called linear interpolation we apply, and this is how it works. Let's go to Excel again. Let me take you to Excel again to show you this, how this price-based royalty works. Let me take you to Excel again. Okay. Okay. Are you there? Are you see my screen?
Yes,
Yes, sir.
yes, sir. Thank you.
So price, crude price, price based royalty. So crude price, okay. I mean, it's not possible that it's zero, but let's even say it is zero. I mean, $0. It doesn't in dollar. I mean, in dollar, and the rates, royalty rates. Okay, that one will be in percentage, right? So when it is when it is when it is when it touches $50, right? Right? 5% we apply, right? Right? When it touches $100,
Yes, sir. Yes, sir.
no, sorry. When it touches $100, when it touches $100, 5% we apply. Okay? When it touches $150, okay, 10% we apply. That was what we said in that
Right, sir.
thing, right?
Yes, sir.
Okay. 5%, 10%. Okay. Okay. So it starts at $50. I mean, of course, price cannot be zero because you need to get some value before you get anything. So, if it's nothing applies, if it's not more than, it starts at $50, but zero apply at $50. It won't apply. It won't apply at all when the price is $50. But when it touches $100, 5% price royalty applies. Okay. If it touches 150, 10% applies. So any other thing between linear extrapolation. So let me see if somebody can tell me what rate we apply if crude price is, let's say, $60. What is the rate that we apply? Based on that PIA says $50, nothing we apply, and below, nothing we apply. For price-based royalty, $100, 5% we apply. $150, 7%, 10% we apply. Any other thing within those range, linear extrapolation, who can tell me what rate we apply if it is that's not expressly stated in the law, but the law talks about linear extrapolation. So based on that provision of law that talks about linear extrapolation, who can tell me what rate you apply when the price is $60?
0%.
Between 0 to 5%.
And what's the specific number?
1%.
Somebody talk. What did you say?
1% actually.
Yeah, correct.
0%.
1%. Actually, 1%. It's 1%. Yeah. I mean, it's 1%, which is 50, right? 100 minus, sorry,
80.
60, sorry. 60, right? Minus 50, right? Divided by, is it times or divided by, I think divided by 5 or times 5? I think it's times 5. So want to share 5%, between 50 and 100. And that essentially means every 10 is 1%.
Let's
That's
say
what it
times
means,
zero
right?
point zero five.
You said what? It can't be 200.
0.05 times
I want to
0.05.
generate the formula for it. You said?
It will be, I think it will be 5% divided by 100 minus 50. Is that it?
Divided by. Is it 100? 100 will not be there now. I mean, 60. I mean, 100 will not be happy at time because it's not up to that. I think, is it this? No, it can't be this. We know that has to be 1%, but I just want to generate the formula to derive it. I think it should be 60 minus
50 times 5%. That's a 1.
60 minus 50, right? Okay.
Yes, sir.
Times 5%, right? They can't be this. I mean, the answer is 1%. The answer is actually 1%, but I'm trying to generate the formula to get it. I think is it times 100? Times 100. No, it can't be 100. Is equals to I'm trying to generate this. I normally use something in math. So if 50, if 100 is equals to 5, right? Right?
Yes.
And 50 is equal to 0. Then 60 is equals to what? Is equals to, I mean, I think the first thing is the difference. So we know that, I mean,
The
it's
difference
equals
is
to
10.
100 minus 50, right? Divided by, no, sorry, 60 minus, okay, I think I got it. 60, right? Minus 50, right? That's the numerator divided by 100 minus, divided by 100 minus 50. What is it saying? It's not be 60 now. 60 minus this, minus 100 minus this, times everything times 5. Yeah, that's it. The answer is 1. So it's essentially saying that if the difference between, if 50%, if if the difference, if 5 applies when something moves from, what's the name, 100 to what's the name, 100 to 50 to 100, that if it moves from 60 to 50, it means the movement in the one that equals to 5, I mean, the difference is the one we are looking for, divided by the difference in the one that is equal to 5 times 5. You got it? The most important thing is that it is glaring from here. It is glaring from here that every 10 movement is what? 1. That is why, it is 5%. You get it?
Yes, I think so. We are
And
calculating
every
it as a
movement, if
proportion of
50
that
is 0,
5%.
what did you say?
I said we are calculating it as a proportion of the 5%.
Exactly. Exactly. And because the whole 50 that is in between them is what?
Is
Is
100 minus 50.
exactly.
So the
So
one we're trying to get is 60 minus 50. So 60 minus 50 divided by 100 minus 50. So that's a
exactly, which
part
is
of it divided by the O multiplied
then
by the
divided by 50.
5%.
Exactly. Times 5. Exactly. Because we know that if the whole 50 is equals to 5, then 10 out of it, should be equals to this 1. You got it? So 10, which is the difference. Now, so if the price is 125, what is the cost price ratio that we apply? What is the price based royalty that we apply on 125? What is the cost price royalty that we apply? Price based royalty rather that we apply if the price is
7.5.
Is what?
7.5.
7.5.
Exactly. You can look at
7.5.
it. You can look at it. Every 10 is what? Every 10 is 1, right? So 110 is what? 6%. 120 is what?
7%.
1%. 125 is what? 7.5%.
7.5%.
You get it? 7.5%. Okay. Or if you want to do it by, normal calculation, either you do it on 50 or you do it on 100. It's still the same thing. Only that if you are doing it on 50, you use 100. If you are doing it on 100, you use 50. But remember, you have to start from 5%. You have to add this 5%. So 7.5%. So this is what this law is saying, that if the price, and the government is doing this because, you can see that when the crude price of oil was 50%, the government say, okay, $50, that's a low price. We're not, don't worry. I mean, we know the price is low, so we are not going to get any extra royalty from price. Oh, $60 is a little. Oh, $60, there is a small, let's get $100, 5%, because $100 is high price. $105, that's a lot of, you guys are making money now. If you chop from there, 7.5% is the royalty rate that we apply based on price. So that government can also get some windfall. Government can also benefit from windfall. A windfall is a situation in which price of crude is so high and all companies are making money. So government set up this law to be able to get to be able to also benefit in periods of high prices. So that's the reason for this. So that is crude. So this is what is called. This is crude. So this is crude. So this is price-based royalty. But for the normal royalty that's based on production, like this royalty is based on how much you are producing. Okay. So this one is saying that for onshore areas, okay, 15%. For shallow water, 12.5%. For deep offshore, 7.5%. Now, who can tell me the reason for this graduated rates in royalty rates by according to the various terrains? Onshore areas, 15%. Shallow water, 12.5%. Deep offshore, 7.5%. Why? What do you think is the thinking of government? Who can tell me?
So could it be that they are trying to compensate? Hello? Hello? Can you hear me?
I can hear you.
I can hear you.
So could it be?
I can hear you.
Could it be that the government is trying to like compensate the people that do this deep offshore, because it's like inside the water, so they're trying to like leave them with enough compensation?
I'm in a meeting. Please don't call me now. I'm sorry. I'm in a meeting.
Oh. Hello?
Hello, come again, please.
Okay, so I was trying to say,
come again?
Like, the higher the amount of tax, the more money you have to surrender to the government. So reducing it would sort of be a way to compensate or to lessen the burden that these deep offshore people will bear, especially because of how like capital intensive the work they do is.
That's correct. So you can see that generally deep offshore production, crude production, tends to attract more generous fiscal terms. Like government tends to be a little bit more generous with them because they know that it takes a lot of money to you to say you want to go and invest inside water, inside water. That's where you want to go and get your own oil. Bonga field of Shell, Agbami field of Chevron. Those fields are inside deep offshore water. Okay? So those fields, government tend to generally compensate them with more reasonable fiscal terms. Okay? That's why you can see that onshore is easier, it's much easier because that one will not cost you more, on land. In Eket, in Warri, in Port Harcourt, and all those ones. But the ones that you are investing inside water. So that's why the rates are higher for onshore areas, which is much easier. A little bit, not as high as onshore, but higher than that of deep offshore, because that one can still be, is still much easier, but not as easy as onshore. Then deep offshore 7.5%, because they know that those ones those ones take a lot of. The frontier basins are areas that are, even though they are inland, they are with onshore, but they are areas that people are not really concentrating on for now. Areas that are just coming up. They know that there is petroleum deposit there, but they are not necessarily being productions are not happening them. Like the Chad Basin, the Bida Basin, Anambra Basin. Those ones are not much activities are going there. So the government is using that one to encourage people to go and so the lower rate for those ones just to encourage people to go, guys, come and explore, go and produce in fields that are frontier basins, that are the road less traveled, the roads that are less traveled. So that's why government like the Anambra Basin, Chad Basin, that's Bida Basin, Sokoto Basin, and all these areas that they know there is good oil there, but not much activities have really been going on there. So it's just to encourage people to go and invest in those areas. That's why the royalty rate has been kept low for those frontier basins too, 7.5%. Okay. Now, for the government now say, you know what? But for onshore and shallow water terrains, including marginal feeds, small feeds, if you are not producing up to 10,000 barrels, okay, government are not saying, if you are not producing up to 10,000 barrels, you are just we know that you are just, you are just a little, you are just a small company, small feed, producing less. Okay, you have a special rate. On the first 5,000 on barrels, 75% we apply. Okay, so this one is just to encourage all the smaller players in the industry who are producing on small feeds to just give them that sort of encouragement, sort of tips, them to be able to just encourage them to also invest so that law does not favor the bigger players. Okay, so if you are producing less than $10,000, 10,000, if you are onshore and you are producing less than 10,000 barrels per day, okay, rather than this 50% to you, 5% apply to you for your 5,000 barrels. On top of that, the next 5,000, up to the next 5,000, 7.5% will apply. So if somebody is producing, let's say, 7,000 barrels per day, and it's an onshore, rather than government applying 50% on you, they will apply 5% on your production for the first 5,000. The remaining 2,000, because remember it's 7,000 you are producing, you apply 7.5%. So that is just to encourage smaller players in the industry. So this is the royalty rate that apply. This one only irrespective of the price. This one is based on terrain and based on the terrain and the production size. Okay. So you pay this, you still pay this this royalty, no, you pay this one too. Except the price is less than $50. That's when you will not pay this one. So for gas, okay, the rate is 5%, which is the lowest, 5%. So irrespective of the volume of gas you are producing, you are going to be your royalty rate is going to be just 5%, and that's to encourage you to, because they know gas needs better fiscal. Many people will prefer to go and invest in oil than gas. So for gas, government needs to encourage you, and the government has set the price at 5%. Sorry, the royalty rate that applies to at 5%. And to make it even much easier, government are now saying that if you produce that gas, but you're not exporting it, to supply that gas for domestic market, you're selling to a company in Nigeria that will use it to generate electricity, or you're selling to a Nigeria that gas that you are producing is being to be used in Nigeria, not that you are selling to it that will export it, or you are selling it yourself. If that is what you want to do with that gas, we will even reduce the royalty rate for you to 2.5%. So gas, if you are producing gas for export, 5% royalty will apply. If you are producing to use or to sell locally, 2.5%. You get it? So this is the royalty rate for gas production. So company income tax are not tax that applies in Nigeria. Like I said, this tax is not limited to oil and gas operations. All companies in Nigeria are subject to this tax. Before, petroleum upstream companies used to be exempted from it. They have their own tax called the petroleum profit tax. But now, government are now saying for upstream companies company producing crude oil, you are going to pay hydrocarbon tax. You're also going to pay company income tax at 30% of your profits. Okay. So so that is it. Okay. But remember, for gas, hydrocarbon tax don't apply on gas. Only company income tax will apply on gas. So if a company is producing food, company income tax, okay, and hydrocarbon tax of 30% also apply, except in the case of marginal fees, where 15% you apply. But this company income tax apply to everybody. Okay. So another thing under this company income tax is there's another restriction. There's another restriction under the company income tax that two-thirds, that is 66.7% of your capital allowance, your capital expense, you are deducted from your revenue as amortized for that year. Okay? Based on the law that 2023 finance. But okay, that rule will not apply to companies in upstream and midstream, oil and gas. You are allowed to claim your full capital allowance. Okay. So in short, company income tax will apply to all companies, whether it is oil, whether it is gas, whether it is midstream, whether it is upstream, whether it is everything. But hydrocarbon tax will not apply to deep water. Hydrocarbon tax will not apply to deep water, will not apply to gas, but to apply to onshore production. Okay. The tertiary education tax will also apply. Tertiary education tax is just 3% of profit. This one is just the tax that is paid to tertiary education tax, fund council, which is used to fund higher education in Nigeria. Some of you who are still students in school, you see TED fund, you hear of TED fund, you hear of ETF, you hear of all these facilities that are done in your school, all those things. This is what you use money. 3% of profit companies in Nigeria, whether this one is not upstream, whether it is dancing, whether it is midstream, whether it is oil, whether it is gas, even if it's a bakery, all companies that are registered as a limited liability company are subject to this tax. Okay. So it used to be 2.5% of your profit, but now 3%. Then we don't have to also apply on dividend. So the dividend you are paying, after you make all the profit and you share the dividend to your shareholders, you are meant to deduct 10% of that dividend and pay it to government as withholding tax. So the PIA also establishes some fund, like some pool of fund which will be used to do some things. So one of such funds is called the Midstream and Downstream Infrastructure Gas Infrastructure Fund, MDGIF, the Midstream and Downstream Gas Infrastructure Fund. So government set up a fund, like companies have to pay some money into it. And what is that money they're going to pay into it? 0.5% of the wholesale price of petroleum products and natural gas sold in Nigeria we deposited into this fund. Government will use it to develop and all of those things. Okay? Every petroleum product sold in Nigeria, every natural gas sold in Nigeria, 0.5% of it will be sent to this fund, which they will use it to invest in gas infrastructure in Nigeria. Also, gas flaring penalty. If you flare gas, okay, and government, there is an amount you have to pay from flaring gas. This amount will also be put into this fund. Okay. But that one will only be used to invest only in community. Also, community is the community in which you are doing your activities. You know, the community within the Niger Delta, you have fish, you have whatever you have. So that is this Midstream and Downstream Gas Infrastructure Fund. 0.5% of gas sold in Nigeria be deposited into this, as well as the gas flaring penalty for 0.5% of wholesale products and price sold. Okay. So, this is how we go to line like plant and all of those things across Nigeria. But for the penalty received for specific gas flaring, that one will be used for the development of the community in which fund. This is another fund that the government has set aside. Government is saying that all your operating expenses for a year, 3% of it for the prior year will be sent to this host community trust fund, and the government will use it to develop the communities in which your operations are. The government will set up a committee made up of the leaders of that community, as well as the leaders of the oil companies, nominees of the oil companies. They will now use the money to develop those communities. That's called those community development fund. Okay. Then the third fund that's also set up under the PIA is called the Decommissioning and Abandonment Fund. Okay. So license holders in upstream and midstream are required to set up a decommissioning and abandonment fund. You open a bank account every year. You have to put an amount there. That is the amount that you will use to restore the area of operation to the natural form. Okay. You know that you have spoiled the ground. You have put the pipeline on the ground. You have put the plant on the ground. You have spoiled the grass. You have done everything. So after years in which you have mixed that grant, that you have made a lot of money from that grant, and there is really everything as you have done, you want to go, then you need to remove all the things you've put on the ground, everything. You need to remove them. You need to return that surface to the natural way, you need to return that surface to the natural vegetation, like the way you met it before you go there. That is called decommissioning and abandonment. Like, you have to commission something means after you have erected something to start it. That's commissioning, right? Decommissioning means to pull it down and return it to out before you put something there. So you need to return the, so the money you spend to do that, you have to start putting it little by little that. You don't have to wait till the end of your lifespan, end of your operation before you do that, because money to do that. So the government mandates you under the PIA to be setting the areas you destroyed for your operations. So this fund is called the Commission and Abandonment Fund. Finally, VAT. VAT applies, on petroleum products, but petroleum products and renewable energy equipment are exempted from VAT. Government just wants to encourage renewable energy investment. Okay, so gas supplied by gas producing companies to gencos are also exempted from VAT, because so that they can encourage you to sell gas to electricity generating companies. They exempt it from gas. Gas supplied, along the power chain, also exempted from gas. From VAT. Plant machinery and equipment purchased for utilization in dancing gas operations are also exempted from VAT. So as the government can encourage you to invest in gas development rather than flood the gas. It's okay, don't worry. Everything you buy, all the capital equipment you are buying, all the plant, all the machinery, all the equipment you are buying to use for gas utilization, don't worry, no VAT on them. Renewable energy equipment exempted from VAT, so that you can invest in in renewable energy too. Then all exports, including oil and gas exports, are also exempted, so that you will not be charged VAT when you are exporting your gas, even though at the point of origin, where the country is going, okay, they would charge you VAT at that end, because import duty, there is VAT on imports at their own end, so that there will not be double VAT. That you are government of Nigeria is paying, you are paying VAT on government for exporting, and at the point of origin, you're also going to pay VAT there. The government, don't worry, you don't pay VAT here. The destination of export, you pay tax. So don't worry. Same like for car example, car entering Nigeria is subject to VAT in addition to import duty. Okay, because they know that at the destination, at the origin, there's no VAT in most countries. All exports, including oil and gas, are exempt. Finally, for government to also encourage people to invest in gas, Section 39 of the Company Income Tax Act says that don't worry, if you are investing in gas for the first 3 years, no tax. Your profits, no tax, no company income tax, because want to encourage you to invest in gas. And on top of that, if you demonstrate that you use yes, you are also eligible for another 2 years of tax exemption, tax holiday, tax-free period. Then the government also says that the dividend, the money you are making for those periods, those first 5 years, don't worry, don't pay tax on the dividend. You share the money to your shareholders, don't pay tax on them, don't pay your own tax on them, because you guys have done well by investing in gas. Okay? PIA also now amended the Company Income Tax Act to say that, you know what? After those 5 years period, if you are investing in mini gas operations, you are entitled to another 5 years of tax break. Okay, so these are the incentives that government have put in place to encourage investment in gas. So, ladies and gentlemen, now stop. This is what all the various ways government make money from taxes and royalties in the oil and gas industry, and the various incentives that are given to oil and gas, whether upstream, whether midstream, whether downstream. I've told you about company income tax. I've told you about hydrocarbon tax. I've told you about company income tax. I've told you about royalties on petroleum based on crude oil, based on production. I've told you royalty based on price. I've told you about incentives on gas. I've told you about deep offshore incentives and all of these things. So, ladies and gentlemen, we've come to the end of this class, and I hope you enjoyed and that you are more knowledgeable about all the fiscal incentives, all the rules regarding oil and gas industry with respect to how government makes money, how government tax the oil and gas industry. Don't worry, I'm not meant to be an expert. You guys are students on young guys, but by now you should be able to understand the workings of those things. When somebody is talking to you and you know that Shell is leaving Nigeria, no, Shell is selling their upstream asset, but focusing on deep offshore because those ones have more generous tax incentives. So, ladies and gentlemen, let me hand over back to Peter. And if there's any closing remarks or any question you guys want to ask before I have to exit in next.
Yes, Sir Jaros, we really appreciate you for your time. Thank you so much, Sir Jaros. Honestly, the way I was on the call throughout, it felt like we should just keep talking, we should just keep listening. But of course, time is not on our side, and we have been imparted with so much during this session. You would agree with me that you wouldn't find most of what Sir Jaros has said in the program today in any or on any website or in any thought leadership material out there. The calculations and all, calculation of royalty with linear interpolation, and then the calculation of cost price ratio limits to determine hydrocarbon tax. You won't find it just anywhere. So that's the value of having Mr. Suraj Oyewale around, and that's the value of you being a participant here. Of course, I'm very certain that you might have some questions or some clarifications to from Mr. Suraj Oyewale. So if you have questions, just indicate by raising up your hands and you can ask your question quickly, please. Does anyone have any question?
Yes, I have a question.
Okay, proceed.
Yes. Thank you, Sir Jarus. This has been a wonderful presentation. And to tell you the truth, I have been enlightened concerning this petroleum sector. So my question is, time to time you'll be hearing NNPC generates also dollars from oil exploration. So I want to know, is it the exploration done by NNPC or all these multinational companies that are into exploration and the crude oil they exported? Is it the total amount that NNPP are declaring, NNPC are declaring? Oh, I just want to be enlightened. Thank you, sir.
So come again. NNPC does what? Like you cited an example. NNPC there's something. Is it divert or something?
Yes, like time to time you'll be hearing NNPC. This is also amount of dollars they generate from oil exploration.
Okay.
So
okay, I got you.
and these multinational companies too have licensed to also generate their to explore the oil.
Question. I got your question.
And export it. Yes.
So there are two ways in which various ways. So NNPC is like the government company that is responsible for the government participation in the industry. They are called the national oil company. Okay. So NNPC has partnerships with all these major oil and gas companies. That's called the joint venture, JV. So in a FIT, for example, NNPC will partner with Chevron, NNPC will partner with Shell, NNPC will partner with Total, NNPC will partner with all of those guys. So the money they are making, they share it. The crude oil they are making, they share it in a ratio. So the share of NNPC is what they give to government, or they or whatever it is. That's one way. But NNPC also has its own stand-alone exploration and production company called a subsidiary of NNPC called NPDC, Nigerian Petroleum Development Company, NPDC. That one is a stand-alone exploration and production subsidiary of NNPC. That one has some partnership with Seplat, for example, in OMA 38, 41, and I think 40, in around that Edo and Delta States area, Sapele and all those areas. So NNPC is also involved with all these companies in all the exploration and production activities, and NNPC takes their own share, 50%, 60%, 55, 45. So it is the money, the portion that is going to NNPC that the NNPC remits to government after deducting their own costs. Okay, so NNPC is involved in some of these things as partners to international oil companies. Okay, so that's the way NNPC generates its own money from this. Thank you.
Okay, that
Adana,
means the multinationals. Hello?
continue. Yes, let me hear you.
Yes, that means the money the multinationals make, that means is their own profits. NNPC has
Yes.
nothing to do with that one.
Yes, it's their own. I mean, it's their own.
Okay,
It's their
thank
own.
you,
Yeah.
sir.
Yeah. Thank you.
Okay, thank you, sir.
Yes, thank you, Adam, for that question. So we would have Adana on right now. You may proceed, Adana.
Thank you so much, sir, for the insightful class. I really learned a lot. So my question is about your explanation when it comes to onshore exploration of
I can't hear Adana. I don't know whether it's from my end. I doubt.
So I noticed that during your explanation, you always made mention of onshore exploration being pouring in water and bringing about so many harms to the community. Can you hear me?
I can't hear you well, but come again.
Okay, so I said I noticed during your explanation that onshore explorations, especially deep onshore explorations, normally are normally taxed. So my question is there any price they pay for the harm that they actually cause to communities? Because I know that while trying to explore oil, that they bring about oil spillage that results in negative impact to the community where they actually carry out their activities. So even though they do these things, the government still tax them less. Or is there any other payment they make for something that they do in that community because of that exploration?
Yeah, I got it. So if you are, so there is the host community levy, which they pay to government. Government uses it to develop the community. In addition to that, they have their own internal mechanisms of developing the community. They do CSR. They sponsor their children to they build schools there. They sponsor their children to on scholarship. They give them scholarship. They build school there. They build hospital for them. They do road in many cases. So so they give back to the community in all of this. It is not the community that owns the land; it's the government that owns the land according to the law. So they are dealing with government who owns the land, and government are taking money, from them, and government is the responsibility of government to develop those ones. But notwithstanding, they are still doing their own, and and by a lot of CSR activities. So they don't have an obligation to, and they give them contracts. They give all those local guys contracts, all their leadership, they give them contracts, catering contracts, different contracts are being given to community people. So, but they don't have an obligation that is sharing money to the people in the community and all of that. They develop the communities. The government is the one that gave them the land, and they are to explore all of these things, and they do as much as possible to give it back to them from giving them school, building schools, renovating schools, doing roads for them, giving scholarship to their children, and all of these things, and giving them so. But they pay money to government by tax, by this host community development levy, which is specifically to be used to develop the communities. Gas flaring, which is gas flaring levy, which is specifically meant to be, they pay government. Government is meant to use it to develop their community, but they don't have an obligation to be, of course, they have to be responsible and do as much as possible to the communities, but they don't have an obligation to do anything to the community. There are laws that guide, the relationship with with all of those, with government. Yeah.
Okay, thank you, Adana, for that question. So, in the absence of any other question, I would just like to appreciate Mr. Suraj Oyewale once again for how real you have been with us throughout this session, the calculations carrying us along. So, and I'm sure everyone is grateful also. So I would just like to inform us that the next session comes up next week, Thursday, that's the 1st of February. So kindly make time for that. And it will be on natural gas development and financing. So as like we did today, will be taken by an expert in that field also, the natural gas field, also that would, give to us practical scenarios and calculations involved too. So thank you very much, everyone, for participating. See you all next week. Have a nice day.